Imagine you're at Davos in 2026. The world's most powerful people are here, and China takes the stage, presenting itself as the anchor of stability in a chaotic world. Their message is clear. Trust us. Our growth is inevitable. The phone in your pocket, the car in your driveway, the very future of the global economy seems to depend on this one promise. But while the media reports on their steady 4.8% growth projections, the real story is hidden in the fine print. A single number tells a different tale, a financial shot across the bow. China's government debt has exploded to over 88% of its entire economy. This isn't just a balance sheet error. This is the result of a $1 trillion mistake, a bet on green energy that has created a massive, unsustainable bubble. And that bubble is about to pop. To understand how China built a $1 trillion trap for itself, you have to rewind the clock. Go back just over 40 years to 1978. Forget the gleaming towers of Shanghai or the high-speed rail network. Picture a nation where the vast majority lived in rural poverty, a country economically shattered and isolated by decades of rigid ideology. In 1978, China was, by almost any measure, one of the poorest countries on Earth. Then, everything changed. The country's leadership made a monumental choice. They initiated a series of radical economic reforms, opening the door to the global economy. This unleashed a new national obsession, a single-minded directive we can call the growth mandate. The goal was brutally simple: expand the economy at any and all costs. And for decades, the results were nothing short of a miracle. From 1978 to 2005, the economy grew at an average annual rate of 10%. An entire generation witnessed a transformation that used to take centuries, compressed into their lifetime. But building an economic superpower, this quickly leaves deep scars. This relentless, state-fueled expansion was volatile. It created enormous dislocations. By February of 1989, the pressure boiled over. Inflation skyrocketed to a staggering 28.40%. Imagine your savings losing over a quarter of their value in a single year. The system was flashing red. This revealed the original sin of China's economic model, a deep-seated fear that if the growth ever stopped, the entire system would collapse. So the mandate could never be questioned. It could only be redirected. When the old engines of growth, heavy industry, infrastructure, and a once booming property market began to sputter, Beijing needed a new frontier. A new industry to absorb colossal amounts of state capital, one that could dominate global markets and project an image of a modern, forward-thinking power. The growth mandate simply put on a green coat. And that is precisely how the seeds of today's crisis were planted, long before the first wind turbine was ever erected. The drive for green dominance wasn't born from environmentalism. It was born from desperation. So why should you care about a debt crisis halfway around the world? Because the global economy is a single machine, and for decades, China has been its largest, most critical gear. The phone in your hand, the components in your car, the solar panels on your neighbor's roof, they all bear the mark of this machine. And right now, it's showing signs of a catastrophic failure. This isn't just abstract economics. We're talking about a phenomenon I call the deflationary dragon. While your country fights rising prices, China is wrestling its opposite. Their inflation recently hit a record low of -2.20%. Falling prices sound good, but for an economy, it's a death sentence. It means people stop spending, businesses stop investing, and the entire system seizes up. With national debt already soaring to nearly 84% of their entire economy in 2023, there is very little room left to maneuver. This isn't a problem for them. It's a direct threat to your pension fund, the value of your stocks, and the stability of your job. How did the world's greatest growth story write the first chapter of its own collapse? To understand the trap, you have to understand the machine that built it. After 1978, Deng Xiaoping unleashed a radical idea on a desperately poor nation: get rich. The party's orders to its officials were simple: grow your local economy, or your career is over. This created a ruthless, single-minded system I call the growth at all costs engine. For decades, this engine worked miracles. Local leaders borrowed money and built roads, bridges, factories, entire cities, anything to hit their GDP targets and get promoted. And for a long time, the debt seemed manageable. Consider this. From 1995 all the way to 2024, China's government debt averaged just under 40% of GDP, a perfectly reasonable number. The engine was humming, but no machine runs forever. By the 2010s, the engine was sputtering. You can only build so many empty apartments and 6-lane highways to nowhere. The returns were vanishing. Each dollar of debt was generating less and less real growth. The party faced a terrifying choice: accept a slowdown and risk social unrest, or find a new, massive industry to pour fuel into. They needed a new story, a new frontier. They found it in green energy. Solar panels, wind turbines, electric vehicles. It was perfect. A way to solve pollution, dominate the industries of the future, and most importantly, keep the growth at all costs engine from stalling. Billions, then $1 trillion, were funneled into the new green dream. But buried deep inside this plan was a fatal flaw, a hidden mechanism that turned this solution into an even bigger problem. So how does a country spend $1 trillion on the future, only to mortgage its present? It's not a single decision, but a system. A machine built to do one thing that is now running itself into the ground. We call this machine the phantom engine. To understand it, imagine you're a baker. The government orders you to bake 1,000 cakes a day to show the world your bakery is thriving. They even give you cheap loans for all the flour and sugar you need. The problem? You only have customers for 100 cakes. So every day, you bake 1,000, sell 100, and 900 cakes pile up in the back, rotting. From the outside, your ovens are roaring. You're buying supplies. It looks like growth. But on the inside, you're just building a mountain of stale cake and unpaid debt. That, in essence, is the phantom engine. And it works in 4 brutally simple steps. Step 1, the directive. Beijing sets a national growth target. Official sources suggest a goal between 4.5 and 5% for the coming year. This isn't a suggestion. It's a command. Step 2, the pressure. That command flows down to provincial and city officials. Their careers, their very futures, depend on hitting that number. No excuses. Step 3, the broken tool. For decades, the tool they used was real estate. Build an apartment tower, a bridge, a new city district. That generated GDP. But that machine is now broken, sputtering under a mountain of its own debt. Step 4, the new mandate. So the party hands them a new tool. Green technology. Build the world's biggest solar panel factories. Dominate electric vehicle production. Corner the global market on batteries. State banks are ordered to open the taps, flooding these designated sectors with capital, whether the projects make economic sense or not. The goal isn't profit. The goal is activity. This is the secret. The growth isn't real economic expansion. It's the ghost of it. It's the sound of construction, the hum of a factory, the reporting of a number. Whether a single product ever gets sold for a real profit is a question for another day. But that day is coming. This isn't just a theory. And when you do the math, the scale of this $1 trillion mistake becomes terrifyingly clear. To see how this machine grinds dreams into dust, you have to look at the wreckage. Our story starts not in a boardroom, but in a city called Wuxi. This is the story of Suntech Power, and its founder, a man once nicknamed the Sun King. He was a brilliant scientist who returned to China with a mission to put a solar panel on every roof. And for a while, it seemed like he would. The government saw a champion, local officials saw a path to promotion. The money spigots opened wide. State-owned banks offered billions in loans with terms that looked more like gifts than business deals. It was a strategy we can call the Gigafactory gambit. Build massive, world-leading production facilities first and assume the demand will follow. By 2011, Suntech was the largest solar panel producer on the planet. Its stock price soared. Investors, both in China and on Wall Street, believed they were funding the future. They were printing money from sunlight. But what happens when everyone is playing the same game? Dozens of other Suntechs, all backed by different local governments, sprang up across China. They were all chasing the same subsidies, all building their own gigafactories. A tsunami of solar panels flooded the global market. Prices didn't just fall. They collapsed by over 70% in just 2 years. Suddenly, Suntech's massive, state-of-the-art factories were a liability. They were burning cash faster than they could make it. In March 2013, the inevitable happened. The company defaulted on more than $500 million in bonds. The Sun King was dethroned, forced out of the company he built. Thousands of workers in Wuxi, who once had secure, high-tech jobs, were now facing unemployment. The gleaming factories that were supposed to symbolize a new, green China became monuments to waste, sitting idle behind locked gates. Investors who bet on the future lost everything. It was a brutal lesson. When the state picks winners, it also creates losers on a spectacular scale. The collapse of Suntech wasn't just a business failure. It was the first major crack in the facade of China's green energy miracle. A warning shot. But this was just the beginning. To understand the trap, you have to see the machine. And the machine isn't broken. It's working perfectly. That's the problem. Imagine you're a local official in a province you've never heard of. Your entire career, your family's future, depends on one number: GDP growth. Beijing hands down a target, say 4.5%. Your job is to hit it. Or else. So how do you generate growth fast? You don't start 1,000 small businesses. That's slow. Unpredictable. Instead, you do what's easy. You build. This is the first step of the mechanism. I call it the GDP compulsion. The official goes to a state-owned bank. He doesn't ask for a loan based on a business plan. He gives an order. We are building a new electric vehicle factory. You will finance it. The bank, being state-owned, has little choice but to comply. The money flows. Concrete gets poured. Steel rises from the ground. Thousands of jobs are created for a time. The official's GDP numbers look fantastic. He gets a promotion. The bank adds a massive loan to its assets. On paper, everyone is winning. This is why most people miss the trap. They see the symptom, the gleaming factory, and mistake it for success. The headlines praise China's green transition, but they don't see the disease. The toxic debt building up inside the bank, hidden from view. It's like a baker who is judged only on the number of loaves he bakes, not on how many he sells. His shelves are overflowing. His production numbers are incredible, but the bread is piling up, uneaten, rotting from the inside out. The factory you just built? It might be the 10th EV factory in the region. It might be entering a market where prices are already crashing due to a massive global supply glut. Its chances of ever turning a real profit, of ever paying back that loan, are close to zero. But that doesn't matter, because the system isn't designed to create profitable companies. It's designed to create GDP. This cycle repeats itself in thousands of cities and towns. A solar panel factory here, a battery plant there, each one a rational decision for the local official. Each one adding another layer of bad debt onto the national pile. It's not a single trillion-dollar mistake. It's a million smaller ones, all driven by the same flawed incentive. The result is a strange paradox. A country can look like a technological powerhouse from the outside, while being eaten alive by debt on the inside. Germany, a global manufacturing leader, has a debt-to-GDP ratio of around 64%. China's is rocketing past that. We've seen how the machine is built. Now we need to see what it's broken. To do that, we have to follow the money. The solar bust should have been a warning shot, a multi-billion-dollar lesson etched into the balance sheets of state-owned banks. It wasn't. Because the machine that built the solar bubble didn't get dismantled. It just got pointed at a new target, the electric car. If the solar boom was a bonfire, the EV explosion is a wildfire. This time, it's not just one city like Wuxi. It's dozens, each one ordered to become a hub of new energy vehicles. The same script, a different cast. Local officials, desperate to meet their growth targets, flood startups with billions in loans and free land. Hundreds of new EV brands appear overnight, many little more than a logo and a PowerPoint presentation. This isn't innovation. It's a state-mandated gold rush. We can call this phenomenon the echo bubble. It's when a system fails, learns nothing, and then repeats the same mistake on a larger scale, with greater velocity. The logic is identical to the solar collapse. Subsidize production, ignore demand, and hope the world absorbs your excess capacity. The result is a tidal wave of cheap electric cars, now threatening to swamp global markets, sparking trade disputes from Brussels to Washington. But inside China, the consequences are more immediate. Showrooms for forgotten brands sit empty. Half-finished gigafactories rust in the rain. And the debt? It doesn't just disappear. It gets rolled over, hidden, and added to a national credit card that is now perilously close to its limit. The cascade has begun. One over-leveraged company fails, pulling its suppliers down with it, who then default on their loans to the local bank, which then freezes credit for the whole region. It's a slow-motion chain reaction, and the shockwave is spreading. And here's where it gets personal. This isn't just theory. The spreadsheets tell a terrifying story. For decades, China's state-run machine operated with a certain financial discipline. From 1995 through the early 2020s, its government debt-to-GDP ratio held steady, averaging a manageable 39.69%. That was the baseline, the foundation. That foundation has cracked. The debt load has more than doubled in a historic surge, with this green energy gamble acting as the primary accelerant. You might hear analysts compare China to Japan, pointing to Japan's colossal debt of over 236% of its economy, and say there's no problem. This is a dangerously flawed comparison. It's a mistake I call the productivity anchor. Japan is a wealthy, developed, slow-growth economy. Its debt is an anchor holding it in place. China is still a middle-income country that needs the economic equivalent of rocket fuel just to function. Its model is built on massive investment generating massive growth. But the rocket fuel is running out. Here's the brutal math. For every new yuan of debt the system takes on to build another solar farm or EV factory, how much actual economic growth does it buy? A decade ago, the return on that investment was significant. Today, the return has collapsed. They are borrowing and spending more than ever, simply to get less and less growth in return. It's like trying to fill a bucket with a hole in the bottom. You can pour water in faster and faster, but the bucket never gets full. You just exhaust your water supply. This isn't a temporary dip or a cyclical downturn. It's a fundamental breakdown in the engine of the Chinese economy. And a broken engine only leads to a crash. This leaves Beijing with 3 scenarios, each more dangerous than the last. Now, you might be listening to all of this and thinking, isn't this just fear-mongering? It's a fair question. And the skeptics have a powerful argument. They'll tell you to look at the data. China's government debt sits at around 88% of its economy. Japan is drowning in debt at over 236% of its GDP. France is at 113%. By that simple comparison, China looks almost prudent. Plus, they keep hitting their growth targets, weathering trade wars and property crises that would have crippled other nations. The machine, they argue, still works. But this argument misses the poison for the dose. It's not about the total amount of debt. It's about what that debt purchased. This is the difference between borrowing for a productive factory and borrowing for a ghost city. I call this phenomenon empty calories growth. It looks like growth. It feels like growth. It even shows up in the official numbers. But it provides no real economic nutrition. It's a sugar high that leaves the economy weaker, sicker, and saddled with assets that will never pay for themselves. And while Beijing certainly has more direct control over its economy than any Western government, that control isn't a magic wand. It can delay a crisis, not erase it. The danger isn't a sudden, spectacular collapse. It's a long, slow, grinding decline. A lost decade, where the demographic cliff meets a mountain of bad debt, and the engine of global growth sputters to a halt. The skeptics see a manageable problem. They see a system that can bend without breaking. But even if they were right, so where does this road lead? What is the final act of this trillion-dollar gamble? 2 futures are branching out from this moment. Scenario A is the one most analysts quietly bet on. Let's call it the Long Stagnation. In this version, there is no sudden crash. Instead, China's state-controlled economy slowly suffocates under the weight of its bad debt. Growth sputters, not to zero, but to a permanent crawl. It's a managed decline, a slow-motion crisis that avoids a panic but guarantees a lost decade. Think of Japan, whose government debt ballooned to over 236% of its economy, leading to decades of economic winter. This is the high-probability outcome. A slow, grinding fade into mediocrity. But there is another path. Scenario B. The stress test. We can call this one the system shock. This is the low-probability, high-impact nightmare. It starts with a single major default, a green energy champion that's too big to fail until it does. The failure cascades through China's opaque financial system, triggering a credit crisis that regulators can't contain. It's a financial heart attack that doesn't just cripple China. It sends shockwaves through a global economy that depends on it. Of course, the skeptics will tell you this is impossible. They argue that Beijing's grip is absolute, that the state can simply order banks not to fail, order confidence to return, and order the crisis to stop. They believe the firewall will hold. But let's pause for a moment. You might be looking at these numbers and thinking, this is all overblown. It's the single strongest objection to this entire story. China's debt isn't a unique crisis. It's just the cost of doing business in the modern world. And if you only look at the headline figures, that argument seems compelling. Critics will correctly point to Japan, whose government debt is a colossal 236% of its economy. They'll show you Italy at over 135% or France over 113%. Compared to them, doesn't China's situation look almost manageable? This comparison is a dangerous illusion. It assumes all debt is created equal. It isn't. This is what I call the asset quality delusion. In a country like Japan, that debt largely finances one of the world's most advanced economies and robust social systems. But in China, a significant portion of that trillion-dollar spending spree went into assets that produce no real economic value. Think about it this way. A better comparison isn't Japan, it's Germany, another manufacturing titan. Their government debt sits at just under 64% of GDP. Why is it so much lower? Because Germany's growth isn't dependent on building empty apartment towers or solar panel factories that sell their products at a loss. The quality of the asset matters more than the size of the loan, and this is where the spreadsheet analysis fails. Because this was never just about hitting a growth target. It was a political decision, a high-stakes gamble on a new kind of power. So what am I doing with my own capital? First, the mandatory disclaimer. This is not investment advice. It is simply a journal of my own thinking, a framework for a thesis I am willing to risk my own money on. You should always do your own research. My strategy isn't a bet on a full-blown collapse. It's a bet on the direct consequences of the machine we've just examined. I call it the deflation export thesis. The idea is simple. A China drowning in overcapacity will dump its cheap goods onto the world, crushing the margins of its international competitors. My trigger isn't a headline, it's a number. When China's producer price index, the price of goods leaving its factories, stays negative for 6 consecutive months, that's my signal. It's a clear sign the deflationary wave is building. The position is a small, calculated short against industrial sectors in Europe that compete directly with China's subsidized giants. Think German manufacturing. For position sizing, this is a speculative edge case. It's a tiny slice of my portfolio, no more than 2%. It's a hedge, not a home run bet. But here's the paradox. Every major crisis births an equally major opportunity. And while this strategy plays the downside, I'm watching for the moment the panic gets too loud. Because after the fall comes the rally. The question is, what will trigger it? The trillion-dollar question is no longer if the machine breaks, but how it breaks. For decades, Beijing built an engine of growth that commanded the world's attention. But that engine demanded ever-increasing fuel, borrowing from the future to pay for today's targets. Now, the final invoices are arriving. This isn't a distant financial story playing out in spreadsheets. It is the architecture of the global economy, and the foundation is showing deep fractures. The choices made inside the halls of Zhongnanhai over the next year will define the next decade for all of us. But what if the ultimate price of this gamble isn't paid in yuan, but in steel? The next chapter of this story is already being written in the South China Sea. Follow our ongoing investigation to see what happens when economic desperation meets military ambition. Because a cornered empire doesn't just implode, it explodes.